Hi and welcome to our December 2022 quarterly report video. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. 2022 was a rough year for asset prices around the world, horrible for equities, and also for the first time in some 70 years, a horrible year for bonds as well. In fact, a blended portfolio of equity and bonds had its third worst year in the last 100. So difficult times out there, and it was the same for the Forager funds as well. Our Australian shares fund was down 24% for the year. That was despite a very significant recovery in the second half of the year, and the international shares fund was down 28%, which is its worst year in our 10-year history and only the second time it's been a negative return. So what's happening out there? Well, rising interest rates and inflation are the proximate cause of all of this, and more importantly, we started 2022 with asset prices that were not pricing in higher interest rates at all, and that has come at a very big shock to markets and forced prices down quite significantly. It leaves us at the end of the year though with dramatically lower prices and therefore higher future returns that we can expect from assets out there, including equities, and in our view, particularly from the smaller cap end of the market, which has been punished very, very severely in 2022, and where we think there are lots of good businesses perfectly capable of navigating what is going to be an almost certain recession. I talk about all of those factors in my introduction to our quarterly report this month, so grab yourself a copy and have a read. But now we'll jump on to the respective funds and we'll kick things off with Gaston Amoros and I discussing our Forager Australian Shares Fund. Hi and welcome, Gaston. We talk in the Australian Fund part of the quarterly report about 6 stocks in the portfolio that are under some form of takeover action. What's the latest update on them?
Hi Steve, yes that's right. So 6 companies, mostly tech, starting with the easy one, iSelect, the insurance comparison website. That one's done, the scheme has been approved, the money's in the bank, so that's pretty much done. MSL, we have a scheme meeting coming at the end of January. The stock is trading pretty close to the bid, so we are approaching completion. The next one is a merger of the camper van operators THL and Apollo. The merger has become effective. They have upgraded the number of synergies, and THL now has a line in the ASX, so that's going very well. The next one would be Nitro, where the 2 private equity bidders are battling it out. The last bid is at 215 from the KKR side, and the shares are trading at in the low 220s. So that gives you a sense of where expectations are. Then we have Bigtincan, where in a bizarre sequence of events, the larger shareholder bid 80 cents for the whole company. The management team very quickly turned that down. They raised capital at 60 cents, and they now is trading below the capital raise. Arguably a small capital raise, but still not great optically. And last but not least, ReadyTech, they received the bid at 450. That bid has been, when the shares were trading at 330, that bid has been withdrawn, and the shares are back at 330.
Probably last but actual least, given that that bid has fallen over, but they did reiterate their guidance for the year, which is some really strong growth, and it's a business that management can now get on with running and doing a good job of continuing to grow. Yeah, that Bigtincan one, it's worth having a read of the quarterly report for that. Is a quite bizarre sequence of events. Apollo and THL we've talked a lot about. There's a nice long piece in the quarterly report about that, but it wasn't the only Kiwi company doing well for us in recent times. Gentrack out with some really good results as well.
That's right. The other one was Gentrack, and Gentrack reported a very strong FY22. That was somewhat expected, given they had a couple of upgrades coming into the end of the fiscal year in September. But nevertheless, they put out a very bullish outlook. The revenue for FY23 and 24 was higher than expected. As a result of that, the shares were up 50%, 50 over the next few weeks.
Yeah, that stock suffers from a dearth of liquidity like a few others in our portfolio. It's been through a difficult time, but the turnaround seems well underway, and that liquidity can improve quite a bit if they keep delivering on results. Look, it was a much, much better second half of the year than the first half of the year. It was still an ordinary year of returns overall, but great to see some takeover offers in the portfolio, and even more importantly, some good operating results from those companies we own, and we look forward to 2023. I'll kick you out now, Gaston, and bring Gareth in to talk about the International Shares Fund. The net asset value for the Forager International Shares Fund fell 5% in December, roughly in line with global stock markets and unwinding some recent gains for the fund since June. We've been working very hard to narrow the number of stocks and focus on those opportunities with strong balance sheets and the ability to navigate what is going to be a difficult market. We've also added a couple of new stocks to the International Fund portfolio. Gareth, you and I discussed a company called Yeti on a recent podcast, and Harvey and I also did a video on that stock recently, which is up on our YouTube channel if you want to watch it. But you've also written a piece for our latest quarterly report on Ferguson PLC. Can you give us a quick explanation of that investment?
So, despite the PLC name, Ferguson is a US business. It is focused on. It's a distributor of an immense range of products to trade customers in the building industry, in the plumbing industry, in various infrastructure industries. So mainly construction of some sort or another.
Lots of Australian investors would be familiar with the plumbing supplies company Reece. Is it a similar business to that?
So I think that's the best analogy here, but it's like also it's a Bunnings trade thrown in and various other like big pieces around infrastructure as well. So I think Reece is not quite the right analogy in terms of the number of customers in different industries it serves and the number of individual units, different products that it has.
Yeah, but business model wise, it is a pretty useful proxy and it's been a wonderful investment for decades. Here, Reece, what is it that makes these businesses work? They seem like pretty boring, plain vanilla businesses.
So I've been thinking a lot about this lately. The middleman business really works when you bring together an immense number of suppliers, in this case more than 30,000 different suppliers to Ferguson, and then you're selling to an immense and very diffuse group of customers. So again, more than 1 million individual trade customers there in the US, and you're selling a huge number of stock units. I think it's 2 million different products or even more that they sell. So the customer doesn't come to Ferguson for necessarily the lowest price. They come for the speed, the availability, the execution, and it does help with the total cost of their overall business, but they're not necessarily penny pinching on any one product. 80% of the product is delivered straight to construction sites around the country rather than picked up by the tradies.
Yeah, so the bigger you get, the more powerful that flywheel gets, and then hopefully you just grow and take more and more market share over time. I wrote in the CIO letter this month, we've looked in the Aussie market at the likes of James Hardie, Reliance Worldwide, similar share price movements to what we've seen at Ferguson, that everyone's super nervous about construction, housing construction in particular in the US. Why is that not a concern for you with this particular stock?
It's not a concern. I mean, the price is down for a reason, and I think people are maybe overly focused on it. So about 55% of the business is related to residential customers, but only 20% of the total, so 2/3 of that 55%, is new builds. The other 2/3 of that part is remodeling and repair and that sort of those sort of initiatives that, yes, they are interest rate sensitive, they are economically sensitive, but they tend to have much shallower downturns than new build construction in this kind of environment. And then the other 45% of the business is selling to a very different group of customers on the non-residential side that tend to move in different cycles and that probably have some tailwinds behind them at the moment.
Well, great to see a couple of new investments in that International Shares Fund. Thanks for your time, Gareth. Thanks for tuning in, and looking forward to a 2023 where these businesses continue to grow and prove their worth to some very skeptical investors out there at the moment.